Welcome to The Intentional Exit, a leadership legacy podcast for those who don't just want to retire, but want to do it well. I'm Rebecca Schreiber, and this is where we help you protect what you've built, reduce unnecessary taxes, and create a plan that gives you clarity, confidence, and control. So together, we make sure your exit is not accidental, it's intentional. Before we begin, please note that the information shared in this podcast is for educational purposes only and should not be interpreted as tax, legal, or financial advice. For guidance specific to your situation, we recommend consulting with a qualified professional.
Trillions of dollars are about to make their way from the older generation to the younger generation, and how that happens really matters. And so on episode 22 of the Intentional Exit podcast, we're going to talk about how do you make sure that you hold the most amount of dollars with your family rather than gifting them to places like the IRS, the local government, and people that you never intended to have your money, and how do we kick them out of our estate plan? So this is the Intentional Exit. I'm Rebecca Schreiber. Thank you so much for watching. And if you found any value in our videos, I would love it if you would like and subscribe. It's that free thing that you can do to help make sure that, one, you don't miss any of our videos, but also that you are able to help us to be able to bring more content to you just like this. So let's get into it. Let's talk about how many dollars are actually going to transfer over the next 20 years. It's estimated that it sits somewhere in the neighborhood of 124 trillion. And I know the number that gets tossed around all of the time is $84 trillion, but with things like stock markets rising, it's estimated, if you go and you look and you dig deep, it's estimated that it's more like $124 trillion. And if you don't think that there are people out there licking their chops at this, you're not sitting on the right side of the industry, because I can guarantee you that this number either creates extreme hunger or extreme panic, depending on who you are inside of the industry. But for me, I look at it from the standpoint of the client. What are the things that I should be doing to be able to make sure that this transfer to my family goes as smoothly as possible, and that more dollars end up with my beneficiaries instead of with the people that I never would have expected to show up inside of my estate plan? So what does this look like? How do we protect your family against the vultures? Let's figure it out together. So the first step that we've been talking about over the last couple weeks is this big overarching concept called estate planning. And depending on how you talk to people and who you talk to, they will discuss this estate planning in a much different way. So some of it will come at it from a tax perspective, very few, but some do come at it from a tax perspective. Some of it come at it from a financial perspective. So how many dollars can we create to pass on to the next generation? Some people come at it from a protection standpoint. How do we preserve dollars during your lifetime? And then, of course, there's that transfer tax. So whenever we're moving from those dollars being owned by you to those dollars being owned by your family, there is what I like to call the transfer tax. And it's not a tax that's put out there by the federal government or even by the state. It is just simply the tax that you pay or the cost that you pay during this transfer. And that can either be extremely exorbitant or very, very small, depending on how you actually set this up. So we talked about wills and trusts last week. We talked about how does it actually function? And so when you're looking at a trust, when you're looking at the creation of a trust, then we discussed it moves it out of the public sector into the private sector. And when it's done right and done with an attorney, again, please remember, this is not legal advice. I am not an attorney. However, if you go and sit down with an attorney, most likely what they will explain to you is that the function of a trust, most trusts, is to keep your estate out of probate. Well, why is that important? Why would we want to keep our estate out of probate? And the simple answer is it can be very expensive. And whenever you send your family through probate, you are really losing control of the cost of that transfer. Because whenever you go through a probate process, you're subject to things like filing fees, court fees, attorney's fees. There are different types of taxation that can happen whenever your estate goes through probate versus if you do it through a private process. And that private process happens without all of those additional things, because if we're looking at it together, we know that attorneys cost money, court costs money, filing fees cost money. That doesn't even include things like a forensic accountant. That doesn't include things like a surety bond. And all of those documents that your attorney would have to prepare for you cost money. And they should, right? If your family is going to go through probate, a lawyer has to eat too. They have to be able to take care of their family, and they have a certain rate that they charge based on their education, based on the need. And so whenever we subject our family to probate, we are just signing them up, right? Without a bigger kind of overarching concept, we're just signing them up to go through this process where they are going to need to pay those fees, and those fees are gonna come out of your estate. And so when I look at that, I think of that probate process as being an additional inheritor. So if you've got 3 kids and you add on a probate case, that probate process is going to take a percentage of your estate. They're going to take a chunk of that money simply for the services rendered. And so that is less money. Those are less dollars that will actually transfer to your kids, or to a charity, or to other family members, or whatever it is that is most important to you. And so while the attorneys need to be paid, while the court needs ways to generate income, it doesn't have to be on the back of your beneficiaries. Now, do you still need to pay an attorney to get those things done? Yeah, that's what they're there for. That's that legal advice that you need. But whenever you are transferring those assets, if you can remove that probate process, you're going to remove things like cost. You're going to remove things like time, because probate takes time. You know, most states look at like a 6-month time period at minimum. So that is the least amount of time that for most states it will take. But the national average sits somewhere between 2 and 3 years. And so that is time that your family is losing inside of this process. That is time that your family is losing dollars inside of this process, simply because there are certain things by default, by regulation, that have to happen so that the court can do their due diligence. And so by removing that out of the public process and putting it into the private process, you can bypass a tremendous amount of those costs and those fees. And then, of course, there are the actual taxes, right? So we talked about what are the things that are going to eat away at this transfer. What are the things that are going to pull back and really just keep, whenever you are having this transfer, keep a portion of it? And so we also know inside of that $124 trillion transfer, we are going to see a lot of taxes simply because of the types of accounts that people have put their dollars into. So we've talked about in other episodes, we've talked about the IRAs, the 401ks, those pre-tax dollars that don't get a step up in basis. And so if you are unfamiliar with the step up in basis, a step up in basis is like, hey, I bought a stock at $5 And at the time of my death, it was worth $10. Well, if I would have sold that stock during my lifetime, I would have had to pay taxes on the gain. And if it was a short-term capital gain, then we would have paid the normal rate, right? The normal income rate. If it was a long-term cap gain, then we would have paid it based on the gains profile. So we would have moved into the cap gains section of the tax code, and that is what we would have paid taxes on. However, whenever we pass away, we get a step up in basis, which means, again, if we bought it at $5, we sold it at $10, our kids get a step up in basis at the time of our death, or our spouse, depending, right? And we get that step up in basis at the time of our death. And then anything above that $10 is where we would need to pay taxes. But anything that from $10 or from the $5 to $10, we get the step up in basis. We don't have to pay taxes. However, when we are looking at those accounts that are IRA or 401k or pre-tax accounts, there are completely separate rules on how those are going to be taxed and how they can be transferred. So when we are inside of that marital bubble, whenever we're talking about a spouse to spouse transfer, typically what happens is, let's say my husband has $500,000 sitting in an IRA or a 401k. When he passes away on a spousal, it would come to me and then I would pick up where he left off. So it would be based on my age. It would be based on, my dollars versus his dollars. And then those RMDs, or required minimum distributions, would come out per the rules per when I was born and when they need to start. So like right now, if you are born pre-1960, your start date is when you turn 73. If you were born 1960 or after, your age is now 75. So 75 is when you are required by the federal government to start drawing out a certain percentage each and every year, and you'll be taxed on that. And then whenever you pass those dollars along to the next generation, so as those dollars pass to someone outside of the marital bubble, whether this is siblings or children or grandchildren, they then have 10 years to deplete that account. And that may not sound like a lot, but remember that most likely when they receive these funds, they will also be working. Right? So they're going to have earned income. They're going to have their buckets that is, the 12%, the 22%, the 24%. They're already going to be moving up those tax brackets, and whatever dollars that you send to them will be added on top. And so a lot of times, right? So several times, what you'll see is that those tax brackets where they start to be taxed are more like 24, 32, or even 35%. And so those dollars that are coming out are significantly higher. They are significantly higher than if you would have paid the taxes during your lifetime. So a lot of people think, oh, well, I'm handing my kids this money and they're going to pay those taxes with the dollars that I gave them. So it's fine, right? It's a gift. They should be grateful. And so it's fine if I hand them the dollars and the tax dollars all at the same time. But I always turn around and I say, wait a second, hold on. You're willing to pay the government more because you died, rather than choosing to pay them less and handing more dollars to your kids. Do you really love the IRS that much? Do you? Because whenever we say that, we have to really think about what we're saying. You would rather pay the IRS more dollars because it was a gift to your kids than pay them in a more structured manner and reduce the overall amount that goes to the IRS and increase the amount that goes to our family. And I think if you take a step back and you really look at it, you'll probably love your family members more than you love the IRS. I know I do. And if I can give more dollars to my family and keep those dollars inside of the family bubble, then I'm really doing great things for the next generation. I'm handing down more generational wealth. And there are multiple ways to do this, but if you just sleepwalk through this process, you're going to find that you lose multiple dollars in multiple areas to the IRS, to this probate process, to all of these things. And instead of it staying with your family, that it goes to all of these outside entities. And I gotta think that's not the way that you want to have this happen. And this has created a giant target on people who were born between 1946 and 1964's back. What it's gone out and said is, don't worry, they'll fund it for us, right? Don't worry, they'll go ahead and pay us. And I gotta tell you, I really find that unsettling. I don't like that idea. To me, if you're going to make money off of an individual, and that's what business is, right? If you go in and you buy a t-shirt, that business made money off of you. If you go and buy dinner, that restaurant made money off of you. But whenever I think about how I make money off of my clients, I make money because I am helping them to preserve more dollars for their family than what they ever pay me. And that's okay, because I feel like when you do the right thing for the people that you work for, it's okay to get paid, but it needs to be a mutually beneficial experience. It needs to be something that makes sense for everyone. So let's make it make sense, not only for us as a business, but also for the client, and first for the client, right? Like, that should be first. You should be providing a service or a product or something that puts the client first. And so it is my passion, it is my mission to be able to bring you information that helps you to hold more dollars inside of your family, that benefits not only that transfer, but also your life. You know, if you go back and you watch our episodes about taxation and how it all works, you will find out very, very quickly that my passion is not just to help you transfer these dollars well, but to also structure yourself so that you have more benefit during your lifetime. These things are not mutually exclusive. They work together in combination to make sure that your family holds on to those dollars. You know, I've sat down with countless families who said, you know, I've looked into this tax mitigation thing a bunch of times, but I didn't really understand it. Like, I couldn't decide if I should do a Roth conversion, if I should be buying life insurance, if I should get an annuity, if I should buy mutual funds, what I should do in order to make sure to reduce the taxes. And everywhere I looked, it felt like there was conflicting information. And then we sit down and we kind of pull back that curtain and we hand the client the keys and say, how would you like to drive your car? Because it's your car. You built it, you earned it, you put it together, you scraped and you saved. And now it is our pleasure to be able to help you to transfer these dollars well in the most tax efficient and just time efficient manner possible. And by the way, during your lifetime, you will be vastly ahead simply because you didn't sit back and let life happen. You took control. You put yourself in the driver's seat. We handed you the keys and we helped you to walk through or to drive through every single step. And does it take some work? Yeah, but not the amount of work that you're thinking. If you're thinking that you're going to spend days and weeks and hours and months doing this, the answer is no. We're going to have a few appointments. We're going to walk our way through this. And my guess is, if it would take you over the next 5 years, let's call it 20 hours. 20 hours, and that's probably on the high side. If it would take you 20 hours to save your family tens of thousands, hundreds of thousands, and depending on your status, millions of dollars that could stay with your kids, and maybe if you don't want it to stay with your kids, stay with your grandkids, right? If you could spend time making sure that those dollars stayed with your kids and with your grandkids, wouldn't it be worth 20 hours of your time? You spent decades, countless hours building it, right? You spent time saving money. You didn't just buy everything that you saw that you wanted. You put money into savings, you invested, you worried over it. You did all of these things, and to have it slip away simply because you didn't spend 20-ish hours over the next 5 to 10 years seems like a waste. It seems like maybe you didn't meet the right person, that you didn't have someone who came alongside of you and locked arms with you and put the right professionals inside of your path and who educated you and who helped you to accomplish this. That's what we do. That's how we help our families that we work with. That's how we help to transform the outlook of the American people. And I realize that that's a big, bold statement, but it is our mission to change one family at a time, to come in and to work with you and to make sure that your family has the keys, that you have the keys to be able to pass along and to pass them along in the most cost-efficient way, to hold on and preserve those dollars for your family, for yourself, and to make sure that you are doing your best to create those dollars for generational wealth. I hope that this empowers you. I hope it helps you to take the next first step. Reach out to us, schedule an appointment. Go ahead. We would love to sit down and have a free consultation with you and to set you up on the path to success. Because this isn't about being scary. I want you to understand the choice is yours. In this $124 trillion transfer, how that occurs for your family is up to you. Your family doesn't get a choice. If you leave them a mess, right? If you hand them a mess, they have to deal with the mess. But if you hand them a gift, they get to receive it. And you get to be the hero of your story. Please remember that this is not to be used as legal, tax, or financial advice. Everybody's situation deserves more than guesswork. It deserves intention. And here at the Intentional Exit, we are here to hand you back the keys to be your GPS and to make sure that as you are driving into your intentional exit, you have all of the information and details that you need. I'm Rebecca Shriver. Thank you so much for joining us today. Thank you for listening. And I hope that this will help you to catapult your family into success. We'll see you next week.